Trump and Netanyahu have attacked Iran. The Middle East is burning. The price of oil has shot up. What does this terrible situation mean for European investors? Over my 18 years in finance, both on Wall Street and as a European pension fund CEO, I have rarely seen the markets as uncertain as today. In this video, I will explain the likely direct, indirect, and long-term impact of the Iran war on the markets and what European investors can do to stay protected. Now, when it comes to direct effects, meaning a predictable effect like a war starts and the markets move, I really only see two. The first direct effect has to do with geography. Southern Iran borders the Persian Gulf and the Gulf of Oman, which then opens up to the Arabian Sea and the rest of the world. And between the two gulfs, there is a narrow corridor of water, which is called the Strait of Hormuz. Around 20% of the world's oil production passes through the strait in a given year, because many of the world's most productive oil fields in Saudi Arabia and Kuwait and Iraq basically sit behind the strait. So if the strait is closed to traffic, that can have a dramatic effect on oil prices. And Iran has announced that they are closing off the Strait of Hormuz. Right now, I record this on Monday morning. If I look at the Brent crude oil prices, I see that they are up 9.3% over the past 5 days. So that's a very significant impact. And when oil prices increase, it can have a significant impact on pretty much every other financial market. Now, we'll discuss that in a second, but the point is this effect is direct and it is clear. War starts, oil prices go up. The only other direct effect that I see is that if Trump's starting another war, that is going to mean more money for weapons manufacturers and defense companies. So companies like Northrop Grumman or Lockheed Martin or Raytheon, they're going to be getting more money because when you shoot rockets, then you need to make more rockets to replace them. Now, does this mean that you should rush out to buy these companies' stock? Well, not so fast. There are two reasons why you might want to be cautious. The first reason is, do you actually want to build your wealth off of suffering, misery, and war? I don't. But if that's not a consideration for you, there's a second reason, which is that investors are not idiots. For the past year, it's been obvious that Trump is not a president of peace. He's a president of war. So the stock prices of these companies have already gone up significantly. The prices reflect the assumption that there is going to be conflict. So it is very hard to predict if the price will keep climbing over the next days, weeks, or months. It is possible that you might jump in too late. The problem is that in most cases, the connection between war and stock prices is not a direct connection. It is indirect. Now, there can be exceptions. Of course, if massive conflict breaks out in a developed economy with a big stock market, like in World War II when Western Europe got invaded, that totally devastated Western European stock markets. But if there is a war in some relatively remote part of the world and it's regional, it's relatively contained, then we're talking about an indirect effect on the markets. So this takes us to the second part of our video. What are the likely indirect effects of the Iran war on stock prices and other financial markets? From a humanitarian perspective, whenever war breaks out, that is a tragedy. And you would intuitively think that war is bad news, so the stock market would go down. But looking at history, that is not how it always goes. It is often the case that ahead of a war, as investors get nervous, stocks can go down or be depressed. But in many cases, when the war actually breaks out, stocks can do quite well. For example, when the Ukraine war broke out, when Russia invaded, well, initially there was a drop in the Western stock markets like the S&P 500, but then the market bounced right back up and over the next month, it was quite positive. Realistically, with these regional contained wars, what investors are going to be looking at is what is the longer-term economic impact? And in the case of the Iran war, the question is really, what about inflation? So global inflation is heavily dependent on energy prices. So if the Strait of Hormuz stays closed for a long time, and if energy prices stay high for a long time, this could have a very negative impact. Now, I'm not a military expert. I've seen some people who are saying that it will not be possible for Iran to keep the strait closed for a long time because Iranian ships will get destroyed and their rocket capacity will get demolished. But on the other hand, I've seen people say that it doesn't take that much to disrupt traffic. I mean, you launch a few rockets here and there, and it already has a dampening effect on people's willingness to, ship things through the strait. I'm not going to try and make the prediction. But basically, if this keeps happening, if oil prices stay high, this could lead to significant inflation in America, Europe, and elsewhere. Now, Now, looking at history, there are some examples where this was really catastrophic for the stock market. For example, in the 70s, there was conflict in the Middle East, and a lot of Middle Eastern countries cut oil production. It led to stagflation, which is economic stagnation together with high inflation. And this was terrible for the stock market. There was like an entire lost decade in the 70s. But you have to realize that today the world is quite different from the 70s. Today, America is the biggest oil producer in the world. And in the Middle East, it's not this united front where everybody's going to cut oil production. A lot of countries are not so friendly with Iran and don't necessarily want to support this push to have higher oil prices, right? It is also possible that, okay, there is some disruption, there is some mild effect on inflation, but the US and other countries increase oil production and this becomes mostly a non-issue. We will only see how this develops in the coming months and even years. So when it comes to the effect of the war on stock prices, you've got to remember what Warren Buffett says. The only use of stock prognosticators is to make fortune tellers look good. We don't really know what the impact is going to do. Now, there are certain things we as investors can do to protect ourselves. We'll discuss that in a second. But for now, let's look at a second indirect effect, which is the effect of the war on the price of gold. I recently did a big video about the price of gold because it has shot up like crazy in recent years as investors and central banks around the world seek protection, kind of safety and diversification away from the US dollar. Now, Donald Trump starting another war certainly contributes to that same narrative. And today, on Monday morning, I see that the price of gold has gone up around 3% over the past week. This is a clear impact, but doesn't mean that you should rush out to buy gold. Well, maybe not. Again, the latest news about this particular war are priced into the current price of gold. A lot of the investors who wanted to buy gold to protect from geopolitical risk already did so over the past few years. So that makes it pretty difficult to guess if it's going to be a profitable play if you jump in today. And this is actually a pattern. After an event has happened, after everybody knows about it, trading on the back of it becomes impossible because it gets priced into the market and you're not smarter than many other investors around the world who are looking at the exact same situation. And then we come to a third indirect effect of this war, which is the effect on the US dollar. Traditionally, when conflict breaks out around the world, the dollar has gotten stronger because it's a haven currency. Investors rush to the dollar for safety, they buy US treasuries and so forth. And then there's also a second effect, which is that because today the US is the biggest oil producer in the world, when oil prices go up, there's increased demand for the dollar, and that also pushes up the dollar. And if we look at the dollar-euro exchange rate over the past 5 days, we do see that the dollar has gotten stronger by around 1 percentage point. But this is not exactly a massive impact. And again, it's difficult to say what's going to happen from here because today we also have tailwinds against a strengthening dollar. Yes, traditionally the dollar has been a safe haven, but over the past year, the narrative has been that a lot of investors around the world are fleeing the dollar. They're looking at Donald Trump's wild politics and they are diversifying into gold or other currencies and other markets. So this is a tailwind that pushes against what would normally be expected to be a strengthening dollar, which means that the behavior of the dollar in this particular crisis is a lot less predictable than usual. Because, I mean, face it, Trump starting yet another war in the Middle East doesn't exactly make you trust America more, right? Okay, so now let's talk about the long-term impact this is likely to have on the stock market and what we can do as investors to protect ourselves. But first, I just wanted to mention this. The coming months and even years are likely to be a very intense time for European investors. There's all this news happening, and if you're not a professional investor, it can be difficult to figure out what do you pay attention to and what do you ignore. So if you'd like a bit of help with that, sign up for my newsletter for European investors. Every week I send out insights about what's happening in the market, personal finance tips, or ideas about ETFs and index funds and other investments that Europeans use. We've got over 100,000 readers all over Europe, and I'd love to have you as one of them. So to sign up, simply follow the link that's in the description. So what's going to be the long-term impact of this conflict on the global stock market? Well, the reality is that the global stock market is an incredibly complex system with millions of variables affecting it. So if anybody tells you they know what the impact will be, they're basically lying or they don't know what they're talking about. We cannot predict that reliably. But something that I believe we can say with quite a bit of certainty is that we have entered a period of higher volatility, higher uncertainty, and higher geopolitical risks. It is clear that at least while Trump is in office, we're going to get surprise after surprise, disruption after disruption. The old international order based on rules and laws is basically out the window. And this does not necessarily mean that we'll have bad economic results, or that business will be bad, or that the stock market will crash. Often, as sad and tragic as it is, even war can end up being good for business. And it pains me to say it, but it is true. So you cannot say for sure that this will be terrible for the markets, but it is very likely that this will cause more chaos and more volatility, more risk. And of course, risk can both mean a downside where you lose money, and it can also mean opportunity. You can only benefit from those opportunities if you survive. So in risky times, what is the most important, what I recommend every European investor do, is go back to the basics. Make sure you've got your safety cushion in place. This is an emergency fund that you can spend if there is something that happens in your life where you need money and the market happens to be down, so you don't want to sell your stocks at a bad time. Okay, you need to have an emergency cushion, which is just sitting in a high yield savings account in the bank. Then you need to be sure that you are taking an appropriate level of risk for your age and your risk tolerance. If you're 30 and financially ambitious and you're not worried about the markets, you can put 100% in stocks and ride the roller coaster up and down, right? That's fine. But if you're 55 or 60 or you're retired and you are relying on your savings for your retirement income, you should not have 100% of your money in the stock market. You need to have a good balance between stocks and less risky assets like bonds. And the third thing is make sure you are diversified. Now, if you want to make a concentrated bet on a single market like American stocks, you can do that and it could pay off. But if your goal is to protect yourself from an unknown future with all of these risks, then it's probably a smarter bet to diversify and invest in many different regions, different industries, and hundreds or even thousands of different stocks and bonds. The reality is that the world has seen many geopolitical problems over the past century, and we as investors can learn from past experience. So if you would like to discover the main risks that geopolitics pose for European investors and how to deal with them, you might want to watch this video next, where I dive into that topic in detail.